is expected to keep its main policy rate unchanged when it makes its first interest rate decision of the year this lunchtime. The MPC, which raised bank rate 14 times between December 2021 and August last year, voted 6-3 in favour of keeping bank rate unchanged at 5.25% at its last meeting on the 13th of December. The US Federal Reserve last night voted to keep its main policy rate, Fed funds, unchanged at the current rate of 5.25% to 5.5%. Well, joining me now is Gerard Lyons, Chief Economic Strategist at Netwealth. Gerard, good to see you this morning. You've been quite clear. You think the Bank of England has already overdone it on monetary tightening.
Well, good morning. It's great to be on the show. That's correct. We've read the inflation picture very well here at Netwealth in the last few years. And my view is that interest rates should have hit the peak at around 4.5%. Interest rates are now at 5.25%. So I think we've gone from one extreme to the other in the last 2.5 years, from monetary policy 2.5 years ago being too loose, interest rates too low for too long. Now we've gone to the other extreme of monetary policy having over tightened. That being said, even though I personally think rates should fall, it's all about your messaging and your communication to the market. And therefore, today, I think it's a case that interest rates will remain on the hold at 5.25% at their current level. But I think the key messaging that we are looking for today is whether, after interest rates have now peaked, whether the Bank of England is pausing or whether it's about to pivot. Big difference between pause and the pivot. Pause means they're going to just wait, be passive, keep interest rates at 5.25%. The pivot is about, look, we're starting to communicate to the markets, to the general public that we're prepared to cut rates and to ease. So the messaging is today, Bank of England would have already peaked rates at 5.25%. Are they going to pause, keeping them there for a while, or are they prepared to pivot to indicate that they're prepared to cut rates sometime in coming months?
Yeah, crucial point you make there, Gerard. I mean, inflation in December was 4%, so still twice the bank's target rate. I mean, it's difficult for the MPC to signal a pivot under those circumstances, isn't it?
No, if you communicate properly and clearly, you can. The important thing is we've moved to a situation where the Bank of England, and indeed it's true of many central banks in the West, are now so-called data dependent. They wait for the latest data and then they respond. But all economists know, and Bank of England officials really should know this, is monetary policy acts with a long and variable lag. It sometimes takes 12 months. Some people might say it's 12 to 18 months for changes in interest rates to fully feed through. Now, a year ago, interest rates were 4%. So the full increase in interest rates from 4 to 5.25% has yet to feed through fully. Monetary growth is in negative territory. Financial conditions are still tough. Thankfully, mortgage rates are off their peak. But when one looks at the banking conditions facing small firms, medium-sized firms, it's still a very tough environment. And in terms of communicating, even though inflation, and you're correct, is currently at 4%, and one doesn't expect the bank to be complacent, the reality is their forecasts will show that inflation hits the target of around 2% before this summer. So inflation is falling, it's decelerating, and therefore it's important to anticipate that and factor that into decision making.
Yeah, it's a fair point you make there. I mean, since November and the last quarterly inflation report, market expectations of the trajectory of inflation have really quite changed significantly. I mean, in November, the bank didn't think inflation would hit its target until next year. Would you expect them to change that today?
Yes, I think they should do. One of the things in their communication is they've said that some items that are not core to service inflation, such as private rent, airfares, these have been the things accounting for inflation coming down. But the reality is that when one looks at goods price inflation and at services inflation, it is decelerating, and that should be reflected in their thinking. Now, it's important that in December, the bank voted 6-3, 6 to keep rates unchanged, 3 to raise rates. So they still have a bias to tighten. I think the risks are not to higher inflation. The risks are to growth. Now, thankfully, falling inflation means interest rates will fall, and that will help the economy. Falling inflation also means that earnings start to grow by more than the rate of inflation. That helps the economy. But the level of prices is really high. Say food price inflation is now falling sharply, but the level of food prices is over 26% higher than 2 years ago. So prices have settled at a higher level. So there's a big difference between prices and inflation. But the point is that the bank should have a bias to start to ease, and that should reflect the fact that inflationary pressures are subsiding. And the vote today probably will be 8-1, or maybe even hopefully 9-0 to keep rates unchanged. But the messaging after from the governor is key. And I'd like to think that he will indicate that rates can fall sometime soon. He needs to take the market with him, because we don't want the pound to start weakening too much, because the Americans last night at the Fed indicated the direction of travel for US rates is down, but not just yet. So it's subtle messaging from the Bank of England, both to the markets as well as to the general public. And that's what's needed today.
Yeah, just to pick up on the Federal Reserve comments last night, I mean, they disappointed a few people, didn't they? I mean, there have been hopes of a March interest rate cut, and Powell really talked people away from that last night.
Well, that's correct. The US Federal Reserve in December surprised the markets by talking so openly in a dovish way about interest rates coming down. And so in some respects, last night there was a move to sort of try and temper that. What it really was a messaging from the Fed that they want to be leading, not following. They don't want the markets to say, you've got to do this, therefore you have to act, otherwise you're behind the curve. What the Powell, the Fed head last night was doing was trying to get ahead of the markets to try and guide expectations. So the messaging last night is that the markets basically expected US rates to come down too quickly, too soon, in part because of what he himself had said in December. So the messaging, though, is still this from America. Interest rates are coming down, but not in March, maybe slightly after that. The markets now have priced in the probability of a US rate cut at a 1 in 3 chance in March. Coming back to the Bank of England, currently the markets think that rates currently at 5.25% will fall to 4% by the end of the year. The messaging today from the bank will guide the markets. I think the way to think about it is this, that rates have peaked. Will they pause or will they pivot today? Interest rates certainly will fall this year, I think down to 4.5% by the end of the year, and then settling at 4% thereafter. The risk is not that inflation will go higher. The risk is that growth is too sluggish, and therefore the economy needs a helping hand.
Separately, Gerard, while we have you, the Chancellor Jeremy Hunt overnight has been downplaying the prospect of tax cuts in the forthcoming budget. Do you think he's got the scope for meaningful tax cuts?
Well, he has the scope for tax cuts just because the economy is doing slightly better than expected. The challenge in the UK is that always we debate economic policy as if though it's solely about tax cuts. The tax take is obviously too high, but we need to have a credible policy to turn the economy around, a pro-growth strategy. Tax cuts clearly play their part. What ties the Chancellor's hands is his own fiscal rules. They don't give him much room for manoeuvre. And it's all dependent, therefore, on what the OBR, the official forecaster, says. They tend to read the economy as well as anyone else. And I would expect the OBR will say to the Chancellor, you do have some room for fiscal manoeuvre. What the Chancellor was doing last night was trying to recognise that his room for manoeuvre is limited, and he was trying to manage expectations. So in answer to your question, there is scope for tax cuts. Whether they're meaningful or not is a different issue. And then the politics comes in, whether you should be using any room you have for manoeuvre to cut taxes or do something else. So it's about managing expectations, but the economy does need a helping hand. And it's both about what happens in the budget to fiscal policy and what happens today and in coming months to monetary policy.
All right, Gerard, got to leave it there. Good to catch up with you as ever. Thank you.
Thank you. Thank you.
Some other business news stories for you now. And Shell has suffered a drop in full-year profits following a decline in oil and gas prices. The company's adjusted earnings for 2023 came in at $28.3 billion. That was down 29% on the record performance achieved in 2022. The shares of Shell have risen by more than 1.25% today after the company said it would raise its dividend to shareholders by 4%, while also pledging to buy back a further $3.5 billion worth of its shares over the next 3 months. Eyebrows have been raised, though, by news that Shell's investment in renewables fell last year to its lowest level since 2021. Well, Shell's chief executive, Wael Sawan, told our sister channel CNBC the company was achieving the momentum he'd hoped to see in his first year in the job.
I'm pleased to report, Steve, that the momentum that I had hoped to see coming into the end of the first year has been achieved. We had set up a frame to deliver with a focus on performance, discipline, and simplification, and you see that coming through in our Q4 and overall 2023 numbers, whether it's the strong delivery on cash flow, whether it's the improvements on the structural cost reduction, whether it's the capital discipline, or finally the enhanced shareholder distributions. All of it is coming through, but we also recognize there is still a lot more to deliver, and 2024 and 2025 will be critical years to deliver. So pleased with the progress, but with recognition that there's more to go.
BT's new chief executive said this morning the company was on track to hit its full-year targets after reporting better than expected sales during the last 3 months of 2023. Alison Kirkby, who replaced Philip Jansen last month, said she was looking forward to leading BT into its next phase of development as the company reported adjusted underlying earnings of £2 billion for the 3 months to the end of December. That was up 1% on the final 3 months of 2022. BT's Openreach division was the star performer, raising sales during the quarter by 7% and its underlying earnings by 11%. Phoenix Group, the UK's biggest long-term savings and retirement business, said today it had hit its 2025 target for new business 2 years early. The company, which owns the Standard Life brand and which manages the retirement savings of 14 million people, including former customers of the likes of Britannic, Pearl, Abbey Life and Scottish Mutual, said it enjoyed new business net fund flows of nearly £7 billion during 2023. That was up 80% on the previous year. Phoenix highlighted an improved performance in Standard Life's pension and savings and retirement solutions businesses, but also strong growth in taking on the liabilities of established pension schemes from employers such as Siemens. The shares are up 0.5% right now. I'll be joined by the company's chief executive, Andy Briggs, on Business Live this afternoon. Well, the US dollar is up this morning as hopes of an early interest rate cut from the US Federal Reserve receded last night. Sterling currently off 0.2% against the dollar. The euro off by 0.1% against the greenback as well. Sterling, meanwhile, off 1/3% against the single currency. Well, that Fed decision, along with weakness in the tech sector, induced a sell-off on Wall Street last night, which was followed overnight by a largely downbeat session for stocks in the Asia-Pacific region, only Hong Kong bucking the trend among the major indices. Well, in Europe this morning, stocks have been trading largely to the downside, although, as you can see, the MIB in Milan is unchanged right now, and the IBEX in Madrid keeping its head above water. Talking points today include the Swiss drug-making giant Roche. That's down 3% in Zurich after its fourth quarter results missed expectations. In the same sector, Sanofi is off 2% in Paris on its results. To the upside, Deutsche Bank is ahead by 4.5% after Germany's biggest lender announced 3,500 job cuts, while raising its revenue forecast and its dividend. Here in London, FTSE 100 currently up by nearly 0.5%, 36 points to the good. I should say half of that has come from Shell on its own. Those results, I think it's the dividend increase and the share buyback that have put a bit of lead in Shell's pencil this morning. Another gainer to mention in the FTSE right now, Glencore, the mining and commodity trader. That's up nearly 1.75% after publishing its annual results. To the downside, Next has fallen on broker comment, currently off nearly 2%, while JD Sports is off nearly 1.5% after Adidas said its 2024 operating profits would be below expectations. Outside the FTSE, Paragon Banking is down by 5.5% after it went ex-dividend today. In other words, it's trading for the first time without the rights to the latest payout. As for the oil price, well, that sold off sharply overnight, but it's rallied this morning. A barrel of Brent crude will currently set you back $81.14 a barrel. That's up 0.75% on the session. Well, joining me this morning is Rachel Winter, partner, of course, at Killik and Co. Rachel, good to see you this morning. Got to start with Shell, I guess. Markets lapped up what it's had to say.
Yeah, very good results here. So a very good headline number. And we've also had a really nice increase in the dividend, which will make shareholders very happy. I think often investors view Shell as an oil company, and of course it is, but it's also very exposed to gas. And in fact, the gas division was the most profitable in this particular set of results.
And of course, it had a very strong performance, or looks to have done, on gas trading again.
Absolutely, yes. So it is taking advantage of these movements in the gas price. They have been quite volatile over the last year, and that has enabled Shell to make more money.
And another positive surprise today from BT Group. What did you make of what they had to say?
Yeah, I thought the headline numbers were very good. So we've seen a nice increase in earnings. But if we look at the detail, we can see they have lost quite a few broadband customers. And in fact, the rise in earnings has happened because BT has been able to increase its prices by quite a significant amount. It has been a very difficult decade for BT investors. The share price is down about 70% over the last 10 years. But there is a new chief executive, and I think there is a sense of optimism that there could be a positive turnaround.
Yeah, Philip Jansen, the old CEO, was regularly complaining to me about the share price. What do you think are Alison Kirkby's main tasks ahead of her?
Well, as you say, I expect us to start improving the share price. Investors, I think, have fallen out of love with this company because the share price performance has been so weak. So I think to improve margins, improve profits, and get that share price moving higher will be her targets.
Elsewhere, I mean, the other big gun in the FTSE reporting today was Glencore. What did you make of what they had to say?
Well, they've had a production report this morning, so we're looking at how much of each commodity they have produced. And I thought there were a couple of quite interesting points in here. So the first one was that there has been quite a big increase in the production of thermal coal. Now, this is the most polluting of the fossil fuels, and a lot of countries have been trying to move away from this. But the impact of Russia's invasion on Ukraine has meant it's been difficult for some countries to get hold of the oil and gas that they need, and they have been forced to go back to thermal coal. So quite interesting there to see such an increase in production.
There was a big strategic bet by Glencore in thermal coal. I mean, there's been talk of demerging that division. Did we get anything on that today?
Nothing on that today, but previously they have said they expect to spin off the coal part of the business within the next 2 years, and they would then have two separate companies, one for the metals and one for the coal.
Now, another company reporting today that caught your eye was TSB. I mean, we're obviously expecting decent results from the banks right now because of the higher interest rate environment over the last 12 to 18 months. What did TSB say today?
Well, exactly what you just said. So they've said they've had very strong results, earnings have risen, profits have risen, and that's because they're earning so much more on loans because of the high interest rates. So they have been able to increase their dividends. I thought they also had some quite interesting comments in the report, which gave an insight into the wider economy. So they did say that customers have been a bit more cautious in terms of actually borrowing money. That will be because the interest rates are higher. And they also said it does appear that customers are spending more because deposits are going down. And that's really not surprising given the increase in prices that we have seen over the last year.
OK, Rachel, got to leave it there. Good to talk to you this morning. Thank you.
Thank you.
Still to come here on Business Live. Will plant-based food sales continue to grow this year? Stay tuned.
It's always difficult at this time of year when you walk out on a train station, for example, and it's freezing cold and you can't think forward. But we've been there before. A couple of years ago, 40.3 was the top, and everybody else 37, 38. So, look, it's a silent killer. That's what this committee. Why is it a silent killer? Simply because when these things are reported, they're not reported you died of when people die of of heat. It's not reported you die of heat. It's reported you die of a stroke or a heart attack or other symptoms that go with hot weather, and hot weather does kill as much as cold weather kills. So weather is massively underestimated, and I'm really glad that this committee have got some. Whether they got teeth is another matter, but at least they brought it to the attention. And also the fact that you are actually reporting it on Sky News, because it's almost like a silent story. It doesn't get out there. It doesn't resonate. I think they've got to put this into schools, colleges, and the broader spectrum of society to make them understand, make people understand that weather per se, whether we're talking storms, we're talking cold, hot, understand that when you see these extremes of temperature, these extremes of weather, that we have to act accordingly. So what we do, I could be here for a day and a half, but the point is we've got to move in that direction. So people have got the knowledge to help themselves first, help their families first. So a really easy one would be, for example, painting roofs white. Why? Because it reflects the heat in the summertime. When you get that excessive heat and you touch a white surface, it's very different than touching a black surface.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, till roll data published by the analytics firm Kantar earlier this week suggested the usual January spike in sales of healthy food options did not materialise this year. Well, that may come as a surprise to the plant-based food manufacturer This, which reports that its sales last month were up 24% on January last year. Well, the news comes as the company has named the former Ella's Kitchen boss Mark Cuddigan as its new chief executive. He replaces co-founders and co-CEOs Andy Shovel and Pete Sharman. And Andy Shovel joins me now. Andy, welcome to you. Why are you and your co-founder stepping down?
I think there comes a time with a lot of startups where the skill set from being an early stage founder becomes radically different from the skill set needed to run a slightly larger ship and go from, say, 24 million where we are now up to 100 plus million. It's just so different from early stage founder knowledge, know-how and sort of expertise.
So what is in the new man's in tray?
So, a lot. We are currently in a good place and we've been really outperforming the category. So we're 47% up year on year for last year, when the category was kind of flat, if not in slightly decline. Mark is going to be focused on delivering a whole new range of products next year. End of this year. They're going to be kind of whole food based and really taking on that health first consumer who is more concerned with perhaps processing or nutritional qualities of the food as well. And yeah, he's got a whole host of other things.
The sales uplift that you just mentioned, how much of that came from price and how much from volume?
None from price.
None from price, wow.
I would say, actually, if we're being pedantic, maybe about 5%. We've been performing really well. I think hopefully we're showing that if you're a sort of signpost for quality in the category, then you can buck the trend. It's pretty much down to the products, I'd say.
You touched just now on the whole question of processed food. Is that something that's been a bit of a setback for the sort of meat-free sector over the last 12 to 18 months?
I think it's one of those where there's probably more noise in the press than there is necessarily, a huge dent in momentum. Because there's been a lot of press about plant-based food and its kind of slowdown, but actually, the volume was down 4.5% last year, full year. So that's really not very much. If we take a longer view, say sort of a couple of years around the COVID time, it's up 45%. So it has been, by all accounts, a fast-growing category. And the processed food debate rumbles on. And I think we've just got to get ahead of it and make sure that we have a selection of products for people who are preoccupied with that.
That's interesting because, obviously, you say there's been a lot of commentary. We had the likes of Beyond Meat reporting a drop in sales. Meatless Farm actually went into administration at one point next year. You think that's just the sector reaching maturity rather than anything problems with the category itself? Yeah,
so my take is it's actually the sector is going through quite an unexotic and conventional cycle. And you've seen this with sectors like craft beer, which exploded and then consolidated, with coconut water when that happened, with popcorn. Whenever a category suddenly explodes with interest and hype, there is always going to be some form of correction. And I think that's the stage we're in. We're in that consolidation phase. And I think we'll go into sort of normalised, steady growth after that.
Yeah, as you say, the category is still growing, although people wouldn't necessarily know that from some of the commentary.
Yeah, it's a very emotive one, and it sells papers and news programmes, and I think people have this emotional relationship with meat that they don't necessarily have with so many other food and drink items. When it comes to, say, even dairy-free, there are steak houses and burger shacks, but there aren't like dairy houses and milk shacks. People just love meat, so I think sometimes that bleeds into a bit of a skewed perception in the media about what's going on.
Now, one of the things that I know you're targeting this year is a quarter of profitability. When do you anticipate that coming?
Yeah, so Q4 this year, we're aiming for our first profitable quarter. We're company's just over 4 years old. We've got the growth bit, so we've gone from, I think I last saw you a couple of years, but we've gone from 0 to about £24 million annual revenue in the 4 years. So that's good, but then the profitability piece is the missing bit, which we're focused on now.
Well, we will look and watch with interest. Andy, great to catch up with you this morning, and best of luck with your future endeavours. Thank you. That's it from me for the moment. I'll be back with the afternoon edition, of course, at Business Live at 4:30, when my guests, as I mentioned, will include Andy Briggs, the Chief Executive of Phoenix Group, the UK's biggest retirement savings business. But in the meantime, coming up after this short break, we will, of course, be bringing you the Bank of England Monetary Policy Committee's decision, their first interest rate decision of the new year. We expect no change in bank rate, currently at 5.25%, but we wait and see. We'll bring you that right after this break. Don't go away.